Hello everyone, this is Imani from ETMarkets.com. We keep hearing about this huge surge in retail investors' participation in the equity market. And even though compared with developed market, the share of Indian household saving in equity is still very small, but the surge in the last few years has been remarkable. We have with us Gaurav Mehta, fund manager Ambit Investment Advisors, who will shed some light on the topic and try and explain what exactly is driving this rush to equity and also how the market is looking for retail investors from here on. So my first question to you, Mr. Mehta, is how do you view this trend and what, according to you, is really driving this flow?
Yeah, clearly. So what we've seen over the last 2-3 years, ever since this government came in, is that there has been this huge crackdown on black money, and B, with events like demonetization first and GST now, you're seeing two clear trends emerge because of that. A, formalization of the economy, and B, and more importantly for financial markets, formalization of savings. And as more and more savings, more and more household savings get formalized, then obviously that reduces the appeal of traditional asset classes like gold and real estate, and in turn increases the appeal of financial assets like bonds and equities. So I think that bigger theme of formalization of the economy and savings is what is leading to this huge surge into equity markets from domestic retail investors. On top of that, I think there's one economic factor also at work here, which is that real interest rates have been positive for the last 3 odd years, and when inflation is running at a significantly lower clip than nominal interest rates, then again that increases the appeal of financial assets versus real assets. So I think it's a combination of these two factors: positive real interest rates and the bigger trend of formalization of savings that's leading to the surge into equity markets.
So we've seen this huge rally lasting several months now. Of late, there has been some weakness. What happens if this rally halts suddenly or the market goes into long consolidation? Will it affect this retail inflow?
Yes, so across asset classes, we've seen historically that the near-term returns obviously have a psychological impact on investor sentiment. But that said, equity markets in periods like demonetization or any large dips that we've seen historically over the last 2 or 3 years, you have seen that there is retail appetite to come in and do bargain hunting at lower levels at better valuations. On top of that, there's this SIP flow which continues irrespective of the market direction. So yeah, you might have near-term episodes of blips both on the market and as a result on the flow. But again, I don't think that will derail the structural story of formalization of savings, which should mean that on a structural basis, more and more of domestic household savings will continue to be channelized into financial assets like equities. So yes, near term maybe, but long term I do not see any threat to this structural trend of more and more domestic inflows into equity markets.
Do you think inflows from DIIs and domestic retail investors can match FII flow or at least cushion any big FII outflow at this stage?
Yes, if you look at FI flows, broadly over the last 3 odd months, they've been very sluggish, and yet it's retail flows that have kept the market buoyant. On top of that, if you go back and look at the demonetization episode, the last quarter of the previous calendar year, the October, November, December 2016 period, obviously there were huge outflows, not just from India but from emerging markets everywhere across the globe, for the simple reason that US bond yields were rising, and as a result, foreign investors were sort of pulling money out of emerging markets. But in that episode, retail inflows were quite robust, and that did help cushion that fall to some extent. Overall, if the market is overvalued and if the news flow is negative, then obviously markets will find these periodic corrections, and irrespective of which way the flows are, those corrections are bound to happen in an equity market. But broadly, both FI flows and DI flows have historically had this tendency to counteract each other, and demonetization is a classic example of how that could happen. And it's difficult to pinpoint as to what will be the exact magnitudes of FI outflows and inflows from DIs, but you know, I mean, that at least provides some soothing to the market in a downfall, and that at least helps reduce the volatility and the pace and magnitude of a decline. So from that point of view, you know, it's good to curb the overall volatility levels of equity markets.
And lastly, what do you have to say to retail investors in terms of return expectations from equity?
Yeah, so clearly, you know, at this point, this is any trading valuation, whether you look at the index and say that it's expensive. So, and you know, when you start at expensive levels in terms of prospective returns, that obviously is not always the good news. But you know, what you also have to keep in mind is that inflation looks to be settling down in a relatively lower trajectory on a structural basis. And you know, as that happens, obviously interest rates will also settle down in a lower trajectory versus history. And again, you know, coming back to that point on formalization of savings, the more savings get formalized, the more, you know, it increases the float of available financial assets. And as that happens, obviously it will, on a structural basis, put a downward pressure on interest rates. So you know, on a structural basis, in a world, in a country where you know, most likely your cost of debt, and as a result cost of capital is going to go down, then obviously the return expectations from equity markets should also come down logically. That said, given where the inflation is settling and given where interest rates are, equities on a relative basis, we think, will still continue to be the best performing asset class versus the various investment options that an investor faces. And you know, even if the historical 13-14% headline index CAGR that we've seen comes down to as much as 10, 11, 12%, but the fact that inflation settles at a significantly lower level versus historical standards would also mean that on an inflation adjusted basis, you are still not worse off. So on a relative basis, we continue to think that equities for any long-term investor will continue to be the best performing asset class.
Thank you, Mr. Mehta. That was indeed an insightful interaction, and I'm sure the viewers have had a lot of takeaways from it. This is me, Himani, signing off for the day. See you soon with another ETMarkets.com exclusive video.